Hello everyone, I'm happy to see you here once again. The educational series, has provided an informative and useful video about decreasing term insurance policy. Here, we will try to cover all about decreasing term insurance policy, including what is decreasing term insurance, what is the operation of a decreasing term insurance policy, and why to consider buying a decreasing term policy, and much more. For your kind information, this series has been made only for educational purpose. For any doubt, you can use the comment section. We will try our best. Let's get right to the topic without wasting any time. What is decreasing term insurance? When it comes to decreasing term insurance, also referred to as DTA insurance, it is defined as a life insurance policy with a feature that allows for the reduction of the benefit amount on a monthly or annual basis. In an ideal situation, the size of the policy decreases over time as the coverage period comes to an end or the policy pays out, whichever comes first. Term insurance policies with decreasing premiums are ideal for covering financial obligations. The concept that the loan amount decreases over time allows for the addition of decreasing term insurance as a complement to the loan. The insurance policy is more affordable and can be renewed more frequently. Because of the nature of decreasing term insurance, the policy is typically less expensive than level term insurance. Which is a good thing. Due to the fact that the face value or death benefit diminishes over time, the insurance provider must charge lower premiums in order to compensate for the diminishing risk over time, as explained above. What is the operation of a decreasing term policy? The death benefit of a decreasing term insurance policy does exactly what it says it will do. The death benefit amounts of decreasing term policies are often higher than those of level term policies. And they can be purchased for periods ranging from 15 to 30 years, similar to level term policies. Following your selection of the policy details that are most appropriate for you, you would pay the premium, and over time, the death benefit of the policy would diminish at a predetermined rate, which is typically 1% per year. In the event that you should pass away during that period, the benefit will be paid to the designated beneficiary of your estate. How does the interest rate get determined? Unfortunately, there isn't a straightforward standard formula that can tell you exactly how much your benefit decreases each year, or at what rate it decreases. As is true of many things in the world of insurance, a variety of factors are taken into consideration, including the age of the applicant, their health, and the amount of life insurance coverage desired. However, after you have requested an initial quote from the insurance company, you should be able to obtain the rate as well as other policy-specific information. Why to consider buying a decreasing term policy? As previously stated, the death benefit of a decreasing term policy decreases over time, but the premium remains the same throughout the term. So, why would you choose that over a level term policy, you might wonder. Let's take a look at this. Affordability. Put another way, a decreasing term insurance policy is frequently a more affordable option than a level term insurance policy. In most cases, you can get a comparable amount of coverage for less money over time because the death benefit diminishes over time. It is for this reason that a decreasing term policy may be a viable option for an individual seeking affordable coverage when the premiums for a comparable level term policy are prohibitively expensive. Furthermore, you may be able to obtain a significant amount of coverage without having to submit to many of the same medical examinations that are required for level term insurance applications. Of course, this is dependent on the insurance company and, in some cases, your age as well. For the purpose of paying off debt and other financial obligations. A common trend among many families is that debt and other financial obligations decrease over time, and as a result, your need for a higher level of insurance coverage decreases as well. When starting a family, you are likely to have a significant number of financial obligations and loans, such as student loans or car loans, a mortgage, a car payment, and the expenses associated with raising a child are all on your plate. During that period of your life, you will almost certainly require a significantly higher level of insurance protection. After all is said and done, you'll be able to pay off your car, make your last mortgage payment, and watch your child graduate from college and move away to start their own lives. You will most likely not require the same level of protection at that point. While having the additional coverage provided by level term insurance is certainly beneficial, it is possible that a new family will be unable to afford the premiums or will otherwise require a more cost-effective policy. In such a situation, a decreasing term might be a good option to consider. Another application for this technology can be found in the world of small businesses. It is possible that two or more people starting a business together will find that a decreasing term insurance policy is ideal for covering loans and other business expenses in the event that one of them passes away before the loans and expenses are fully paid off. Finally, in this whole series, we discussed about decreasing term insurance policy, including what is decreasing term insurance, what is the operation of a decreasing term insurance policy and why to consider buying a decreasing term policy, and much more. Hope you understand and found this series more informative and useful. Thanks for joining us. Hope you have a beautiful day.